Hey guys, welcome back to the Investor Army podcast. We have another episode today that I think you're really going to enjoy. So if you've ever wanted to invest out of your IRA, which a lot of people don't know, you can self-direct your IRA to buy real estate. Today is the episode to listen into closely. I have the president and founder of Quest IRA, one of the fastest growing companies for IRA custodians in the country. He's going to share with you a bunch of great information, guys. And he's one of those individuals where you just feel smarter standing next to. I'm pretty sure I'd like to put money on him if we put him on Jeopardy because I'm pretty sure he would win. So, guys, I want to introduce you to Quincy Long. He's a great friend of mine, and he's going to come on here and share with you about IRA investing.
Thank you for having me, Connor. I'm glad to be here.
Thanks, Quincy. Now, we have a large range of viewers on this channel. Some of them don't even know what an IRA is. So let's kind of start real basic and work up for them. First off, you run Quest IRA, which is the custodian company that basically manages most of the investors I know as far as their IRA accounts. And most people come to me all the time and ask, Connor, what's the difference between a traditional Roth IRA? Which one's the best to get as far as a real estate investor? So if you could share some wisdom on that for some of the new investors.
Oh, sure.
Yeah.
So basically, first of all, an IRA is an individual retirement account. So, of course, it's a way to save tax deferred or tax free for your retirement. That's the basic thing. So the difference between a traditional and a Roth, with a traditional, in most circumstances, and there are circumstances where this is not true, but in most circumstances, you get a deduction for putting the money into the traditional IRA. You get to build the account over years and years and years without paying any taxes as you go. But then the price you pay is when you pull it out many years later, after hopefully a lot of accumulation, you have to pay taxes on the way out. The Roth is just the reverse. You put in after-tax money. In other words, you put the money in the account. You do not get a tax deduction. Okay. But even after years and years of accumulation, as long as it's a qualified distribution, you can take it out tax-free. So really the question becomes, do you want to pay taxes on the seed, which is your initial contribution or contributions, or the oak tree, or maybe I should say the acorn or the oak tree, and that's the distinctive. And a lot of people feel like they'd rather have the tax deduction now, and they figure that they'll be in a lower tax bracket when they retire. I think that's negative thinking. To me, to myself, my theory is I plan on being in the highest tax bracket when I retire, if you know what I mean. So I'd rather, I'm a big fan of Roth myself.
Okay. And so basically, what's some of the main reasons someone would benefit working with their IRA as compared to, doing a normal type of investment? Like what are like, so first off, a lot of people have a struggle with the contribution amount and growing that IRA from a small amount. So why would they focus on growing a small IRA account instead of just doing that deal outside their IRA if you're starting out with a small amount?
Well, first of all, you combine several elements into one question there. Let me start out by pointing out that the vast majority of money in IRAs in general, and usually they're in traditional IRAs, is from rollovers of pension plans or 401k plans where they've left the employment and they don't want to leave the money with the former employer, so they roll it into an IRA. That's actually the vast majority of money in the IRAs. It's not the contributions.
Okay. As
far as the contribution limits, it's the same for regular contribution limits are the same for Roth and traditional, which is $5,500 if you're under age 50 by the end of the year, and $6,500 if you're age 50 or over by the end of the year for which you make the contribution. So those are the contribution limits and we're just talking about the basic Roth and traditional there, not the SEP or the simple or some of the other accounts that we could talk about. So then let's presume that you don't have a big rollover from a 401k plan and you want to say, well, I've only got $5,500 to work with. I mean, what can you do? Well, there's a lot of things you can do, frankly. Some of the things that people do is they combine with other accounts, whether they're other accounts that they have or other family members have or just financial friends have, and they combine other accounts to make an investment. So that's one way to do it, is to be participating in a co-investment scenario, if you will. And that can work really well. And if you're doing a co-investment, and this is where myself and my friend John Heyer differ a little bit. If you're doing a co-investment with others that are not disqualified persons, and I guess we'll talk about that in a minute. But if you're doing that, there's no real reason that it has to be exactly equal. Now, if you are co-investing with other people who are disqualified, sorry about that. I don't think they know that I'm on an interview. Sorry. Apologize.
That's all good.
Maybe you should cut that out. I don't know. But anyway.
We'll see if we can.
If you are doing it between people, like combining accounts from people that are disqualified to each other, then you can't vary the profit and expenses have to go according to the same percentage, right? But if you and I did it, Connor, we're not related in any way and don't have any business together, you might be able to negotiate an advantageous split according, not a greedy split, but an advantageous split according to whatever you do. But that does imply, I will say this, that does imply that you have some leverage, such as having the deal. In other words, you're not going to get an unequal split for some deal that you didn't find. Does that make sense to you?
Yeah. So, like, if they go to audit you in a situation like that, and they look at that deal and they say, there's no way this person would have done this with just a random person.
Exactly right. If that's true, if they say there's no way nobody in their right mind would give up, half the deal for a $5,000 fee.
Yeah.
You got to have an explanation for that. And, the only tenable explanation I can think of is, I had the deal.
Yeah. So, as far as disqualified persons goes, can you kind of break that?
Then maybe just be clear, that's not the only way you can do it.
Okay.
You want to hear some other ways? Or?
Yeah, I mean, whatever you want to share with us that's going to help people not get, blow their IRA up.
Because I think it's important. I think it's important to know that there's more than one way to skin this cat, So joint venturing is a great idea. Another idea, which is not nearly as much fun and inventive, but is much probably safer in the end, is to have a debt finance deal. So, Connor, you probably have bought property subject to an existing mortgage, haven't you?
Yeah, we don't do a lot of those, but we buy a lot of them straight from the homeowner, and we get owner financing direct from them. But we don't.
Well, that's another example. Great example, in fact.
Yeah.
But you certainly have bought property subject to debt. That's true, I think, isn't it?
Yeah.
So you can do that in your IRA. Your IRA can actually own real estate. Furthermore, it can own real estate that has a loan against it. But that has two implications that you have to be aware of, though. And the first implication is that to the same extent you have debt on the property, that part of the profit is actually taxable, not to you individually, but to the IRA. The IRA, which normally doesn't file a tax return, becomes a tax-paying citizen of the United States and has to file what they call a 990T as in trust. And it's fairly heavy tax. So that's the downside. And also the other implication is that the debt has to be non-recourse. In other words, the property that's securing the debt is the only collateral the lender has. The lender cannot go after the IRA or the IRA owner because the IRA owner is not entitled to guarantee the note. So those two implications scare a lot of people off, Connor.
Yeah.
But it shouldn't, because that's kind of like saying, well, I'm not going to invest outside of my account because I might pay taxes. Well, that's true. If you generate income, you might pay taxes, but then you've got what's left over, which still can be a good way. And that's probably, it's not, I would say it's probably a kind of a safer way to do things because you're giving the government something and they're less likely to get upset about you growing that account quickly. Also, don't get too crazy with concern, because if you build a $5,000 account into a $10,000 account, that is not even going to be on their radar, of course. It's when you have a Roth IRA of $500,000 or $1 million or more that they're going to peek up and say, wonder how he did that.
Yeah, because they don't see the transactions in it every year. They're just seeing
exactly.
the difference in the value.
And obviously, you want to keep good records of the transactions and make sure they're structured as investments and not as a donation of your time and services. But go ahead.
Yeah, I mean, I think that's where people don't understand is that you can't be running a business out of your IRA. It has to be an investment.
Well, that's not quite true. You can't be running a business. Your IRA can own a business.
Really?
For example, my 401k plan owns a restaurant. Well, what it owns is a share of a limited liability company that owns a restaurant. But because that's a pass-through entity, effectively, my 401k owns a restaurant. So the income from that restaurant, the net income from that restaurant is taxable to my 401k plan. But that's okay, because if it's very profitable, then I've still got something left. And if that profit that I have left is better than I could get by investing in a mutual fund or some uncertain stock, it's worth it to me to go ahead and do that. So your IRA can own a business. You just can't run it, nor can any other disqualified person.
Okay, I appreciate you sharing that. So I think a lot of people have fear about, there's all this, what happens if you do a prohibited transaction? What happens if you mess up? What is like the outcome? Nobody ever talks about that. Like, what would your penalty be? What is?
Sure.
Yeah.
Yeah, I mean, they're right. You need to be concerned if you're going to do a prohibited transaction. That's why it's so critical. That's why at Quest IRA we do a lot of free education. We don't give tax, legal, structuring, or investment advice, but we do try to educate the clients because an educated client is our best client, if you can understand that. And yeah, there are rules. That's absolutely true. So what are the rules, or what can you do and what can't you do, and what are the penalties? Well, you started off with what's the penalty. Yeah. So the first penalty, if you do a prohibited transaction in your IRA, is that the IRA is deemed to be disqualified as of January 1st of the year in which you did that prohibited transaction. And so that has all kinds of implications. For example, if you're under age 59 and a half, then you get a 10% premature distribution penalty, in addition to any taxes owed on the distribution from the IRA. Another penalty is that anybody else who's disqualified who participated in the event, such as if you loan money, for example, to your daughter, and then not only would your IRA blow up and be distributed, but she would be penalized 15% of the amount involved for every year that was outstanding. In addition to all of that, you may have to pay understatement penalties because all those years, because they don't catch this right away, you understand. So all those years in which you thought you had an IRA, you actually were making all this money in a taxable environment, so you underreported your taxes, and so you got underreporting and penalties for doing that as well. So that's pretty nasty. And just outside of the tax world, if you file bankruptcy, normally IRAs are protected in bankruptcy, but if they go digging through there and find a prohibited transaction, the bankruptcy trustee can effectively void the IRA protection and go after your IRA. So basically, the better way to do it, Connor, is just to learn the rules and stay within them, because believe me, there is many easy ways for you to make a fortune legitimately by staying within the rules.
Yeah. So guys, if you're in Houston, Austin, or Dallas, basically Addison, they have offices there that you can go and y'all have weekly trainings, from what I understand, in most of those offices. Right. So guys, this is something you don't want to kind of just do Wild West style. You want to go in and make sure you know what you're doing, and Quest can help educate you on this. Do you have like a website that you put those weekly trainings on there that people that are not in?
Well, nicely, Connor, they're actually all broadcast under Facebook Live.
Okay.
So I'm not sure how. Okay, I'm going to confess here that I'm not really sure how Facebook Live works, except for I have to watch what I say, because one time I was talking and telling a story about my wife, and she was watching while I good story, but she typed on Facebook, "Watch it, buddy." But anyway, so they're on Facebook Live, and they're Tuesdays in Houston. They're Tuesdays at 9:30 a.m. and 6:30 p.m., and on Wednesdays in the evening only in Dallas. Those are our regularly scheduled classes. And you can go to our website at www.questira.com. That's QUESTIRA.com, and find a lot of the education. Or if you know how to look up Facebook Live stuff, then you can go it that way. And if you don't know how, like I do not know how, you just call one of our IRA specialists, and they can help you find the information.
And we'll put those links below the video here so y'all can go find that pretty easily and connect you to them on Facebook, because you guys need to be learning what you're doing when you're getting into this, because even if you don't have an IRA to invest money out of, and you're an investor, you're an active investor, you need to be able to understand it enough to explain it to a potential lender, because
Absolutely.
many of these people, they don't know that they can self-direct their IRA, and if you're the one that goes and educates them and shows them how to do it, who do you think they're going to choose to lend on the deals? And I know that you told me in the past there's, I don't know how many millions of dollars sitting in IRA accounts at Quest.
Well, I don't know that we want to put that on that tape, but it's a lot.
Yeah. So, but these people need help getting that money into play and into deals. And so that's another good reason to go down if you're in Houston, Austin, or Dallas. Guys, it's a great networking opportunity to go down there, whether you have money that you need an investor to help you get into play, or vice versa on the other side. You can go down.
Yeah. Obviously we have a lot of networking. Our offices, you're correct, are in Houston, Austin, and Dallas, and we have networking there, but we go all over the place. And that includes, for example, we've got a boot camp, an all-day boot camp in Seattle coming up on June 24th. That's 2017. I don't know how long these things hang out there. And we have another one coming up in Seattle in September. So, and we go places where meetings are held, and for example, we'll be in Hawaii and Vegas, and I can't even remember how many cities. So we're all over the place, and we're there to educate the potential clients and clients.
Well, while we're on that, let's go ahead and talk about the Financial Friends Network and what you and Walter are doing with that. Because basically, this guy, so he'll tell you more about it, but this is a group of individuals that I've recently been following around with, because they're all amazing people. The information you're going to learn, I mean, that's basically everything I've learned about IRAs is from Quincy. Pretty much, I can tell you that for sure. Because
Quincy and Walter and all the other people that hang out on the Financial Friends Network. To be fair, Connor, a lot of people know about IRAs, and we all get together and we talk about them, and we do deals with each other and stuff like that. That's what we do at Financial Friends Network. So you can't say it's all attributed to me.
Well, you got ahead of me there, because guys, I mean, pretty much all of them, I mean, most of them come on here. Walter's been on here. So a lot of the guests that come on here are from this network that they put together over the years. And the good thing about their group of individuals is there's someone that does something with almost every exit strategy, whether it's Airbnb, vacation rentals.
Right.
It's just such a diverse group. There's really no selfish people in there. Everybody's looking to help each other. And on top of that, we go really, really cool places. And and so we're going to Alaska here in September. And what's the next one after that? The Caribbean in early next year?
Yeah, next one is in January in Caribbean. The one after that is probably the Greek islands in June, though that's not set in stone. The next one after that is we're going to do an interesting one next September, September 2018, not 2017. We're going to go out of New York and up to Maine and around Nova Scotia to Quebec City on a cruise next September. That should be fun too.
And they just got back from an almost 3-week trip to Europe down the Rhine River. And guys, so basically what these events are like is it's a networking event where you go, and basically we'll go somewhere around the world, usually on a cruise. And in the morning, you're going to have X amount of hours of presentations by top investors and individuals within the community. They're sharing, high-level presentations, and then you have basically period during the day for yourself and your family. And then in the evening, you have another round of presentations, and then everybody eats dinner together. And we do that all week. And so you get to spend time with people that you probably wouldn't have a chance to do so. And you're able to build a good relationship. And help them with their business and they can help you with yours. And so, guys, if you haven't, go check out financialfriendsnetwork.com. That's the correct website, right? Or is it the financial?
That's right. That's Walter Wofford and my website. It's not really officially related to Quest. It's just what Walter and I do.
Okay, great. Yeah, guys, definitely go check that out. So back on to, the investing out your IRA. So let's go through kind of what some of the main prohibited transactions are, just so people can kind of, not jump out there and do something that they're not supposed to do.
Sure. Well, and these are the most important thing to remember, I would say, about the prohibited transaction rules are that you've got to understand that it's either directly or indirectly. And it's the indirectly part that, kind of trips people up, if you will, because they think they're all very, very much more clever than the government. And the government, by putting in the or indirectly thing, can trip you up. But I'll get to that in a minute. But so what are the basic restrictions? First of all, every prohibited transaction has what they call a disqualified person involved. So you really, before you get to the transactions, you got to know who the disqualified people are. And it's a fairly long list, but here's the essence of the most important ones. And these are not all of them by any stretch, but the most important ones. You are a disqualified person to your IRA. And you go, wait a minute, that's my money. We say, no, you have to look at it as Mr. IRA's money. Now, Mr. IRA may die one day and give you all of his money, but until he does, you're actually a fiduciary or a caretaker for Mr. IRA's fund. And you have to act with only Mr. IRA's best interests at heart and not yours. True, he might die one day and leave you the money, but until he does, it's his money and not yours. And so you're disqualified, as is your spouse. And these other people that I'm going to list are disqualified primarily because they're too close to you to make the transaction an arm's length transaction, which is what you're required to do in IRAs. So if these people are kind of deemed to be just too close to you, if that makes sense. So you're disqualified. That means your wife or husband is disqualified. Means your kids and grandkids and any lineal descendants are disqualified. Your parents and grandparents and any lineal ascendants are disqualified. And any partnership, corporation, trust, or estate that's owned in any combination of those people, 50% or more of, is disqualified. And furthermore, if you disqualify the entity, then any 10% or more shareholder, manager, director, 10% or more joint venture, all are going to fall into the category of, our key employees also are all going to fall into the category of disqualified people. And that sounds like a long, complicated list, but if you think back, what they're trying to do is just say, hey, IRA investments are supposed to be just that, investments, and they're supposed to be on an arm's length basis. And if you think about it, if you've got an employee that makes more than 10% of the wages of your company, say, for an example, are they really going to be a neutral party, an arm's length transaction if you do business with that person? No, not really. So you got to understand there's always a disqualified person involved in every prohibited transaction, and usually more than one. So with that little brief background, what can't you do? Well, you can't buy, sell, or transfer an asset between one of those disqualified persons and the IRA. And again, that's directly or indirectly. So for example, I couldn't say this, hey, Connor, why don't you buy this house from my IRA and then wink, wink, next week we'll transfer it to my wife. Because that would be doing indirectly what you can't do directly. That's an example. So you can't buy, sell, lease, or exchange any property between them two. You can't extend credit between the IRA and a disqualified person. Now, that sounds pretty simple, right? Well, most of you know you can't, for example, borrow money from your IRA, but you also can't advance money on behalf of your IRA. So an example of that would be you're not going to be allowed to advance money to repair the property that your IRA owns out of your personal pocket. You're effectively extending your personal credit, your personal assets to allow that IRA to do the deal. So, boy, I'm really popular today, aren't I?
You're a busy man.
Oh, good Lord. Hang on just a
Let's answer
minute.
it live on call.
I think that's my oldest daughter, actually. Sorry about that, Connor. I'm just a popular guy today.
When you run a company the size of Quest, people are on demand.
Yeah. So where was I? What was I saying?
Well, let's talk about, so when you go up the qualified or disqualified ladder for your family, it's vertical, right? But if you go horizontal, from what I understand, if you have cousins or nieces or nephews, are those still disqualified?
Good question.
Are those?
Well, okay, that's you're getting into some nuances there, and I'm okay to go there, but just realize these are nuances. What you can't do is do anything either directly or indirectly to benefit a disqualified person, like we said, and you understood that, right? So, is your brother a disqualified person? No, your brother's not a disqualified person. However, a benefit to somebody in whom you would have an interest, which would affect your best judgment as a fiduciary, which might include your brother, is deemed to be an indirect benefit to you. And again, we get that direct or indirect deal. So you could still get in trouble by doing business with your brother, depending on whether that was deemed to be an indirect benefit to you. And I can go a lot of stories on that.
Yeah.
But that's probably good enough for a podcast, I'm thinking.
We don't want to head explode all of a
sudden. And I think I was on the extension of credit. So, for example, if your IRA buys a house, you're not really supposed to, well, you can't really under the rules, advance the earnest money. That has to come out of your IRA. If you have an expense on that house that's owned by your IRA, it has to be paid by the IRA. So everything goes through the IRA for the IRA-owned assets. That includes expenses as well as income. It all runs through the IRA because the IRA is a separate legal person than you. But remember, we get down to directly or indirectly. And one of the most interesting cases that came down, which didn't surprise me at all, came down with the court saying it was a prohibited transaction because the owners of the IRA started a corporation and they guaranteed personally an asset by an IRA-owned corporation. In other words, a loan, sorry. So in other words, they bought a company, and in purchasing the company, they set up an IRA-owned corporation to buy that company, and then they personally guaranteed the note. And that was deemed to be a prohibited transaction. They said, well, we didn't extend credit to the IRA, we extended credit to the IRA-owned entity. And the court said that's indirectly doing what you can't do directly, so that is a prohibited transaction. The next one is you can't provide goods, services, or facilities between an IRA and a disqualified person. And wow, that's where it gets into the most confusing area, because what is a service? I mean, as a fiduciary for the IRA, you're required to find good investments for your Mr. IRA's funds, right? That's your duty as a fiduciary. So where do you cross the line between doing investment type activities and providing services? And all of us, my attorney friends and everybody else would like to know the answer to that question. But it's one of the most vague questions that's out there is, when do you cross the line into the providing services? One thing you can say for clear is that you do not want to donate all your time to your IRA because the government wants taxes and fees from that. Everybody, you can understand it. So, for example, I started Quest IRA with $16,500. Now, I've often thought it's worth quite a bit more than that now. And I have often thought, well, what if I was married to a doctor and could have just donated my time for the last 14 years to building the company? Could I have done that? The answer is clearly no, because I would have been donating my services indirectly to my IRA. So that gets into a whole bunch of hairy stuff that we could get into for hours on end.
Yeah.
But that gives you some idea. anything that would be a paid for service outside of the IRA probably should not be done within the IRA, if you can appreciate that.
Yeah.
And there's a couple others, but the most important other one is use by or for the benefit of a disqualified person of the income or assets of the plan, which sounds like a bunch of words. But for example, if your IRA owns a beach house in Belize, can you go stay there and check it out and make sure it's safe? No, because you would be utilizing as a disqualified person in the income or assets of the plan. So that's a very nebulous standard, which you don't get much guidance on until you trip it up and do something wrong. But if you make your IRA have an investment that in some way, either directly or indirectly, benefits you or any other disqualified person, you're running into the potential of blowing up your IRA. That was cheery.
That was a lot of good information. People at home are probably like, I'm going to have to go back and rewatch that a few times. But you're going to learn through repetition, guys. So go listen to it over and over and go back and get on his Facebook Live, because the more you hear it, the more you're going to consume each time. And then it's going to get easier as you start to pick up that information. Now, most people, especially someone like me who's younger, who was just opening up an IRA account, I'm not going to have a lot of money in it. And that's what a lot of people want to know. How do you grow a small IRA account? And I've asked you this before, about wholesaling. A lot of people want to know, you can't just put a small amount of option money up and just wholesale a house for 50 grand and juice up your IRA that way.
Well, and why can't you do that? Well, the reason is that and the IRS has various ways to attack that, okay? Just pure wholesaling with nothing else there. Now, let's not get confused. I am not saying in any way that you can't own an option on a piece of property or anything like that. What you can't do, again, is donate your services. And the problem is that wholesaling, Connor, for example, you wholesaler, right?
Yeah, we do.
You probably don't, I'm assuming, you don't have to answer this, but I'm just going to assume that you're like most wholesalers and you report that wholesale income as active income for your business, right?
Yeah.
But if you think about it, you report it as active income because it's service type activity. It's not investment type income. So in the eyes of the IRS, then you might be violating the prohibited transaction clause that we talked about by providing services to your IRA if all you did was stuff the money in the account. Another way they can attack it, if they attack it that way, it blows up the account, as we discussed earlier. On the other hand, they also could say, well, and this is probably more common these days. That doesn't mean they couldn't attack it the other ways, but more common these days, they might say, oh, now, Connor, you just made a $50,000 contribution to your account. That's an excess contribution to your account, and attack it as an excess contribution. And that's delicious if they do that, because the penalties don't blow up your IRA, but you pay 6% of the amount involved for every year it's in there. So that could be a lot lesser penalty, but it's still a penalty. And the third thing they could attack it by is by saying you ran a business in your IRA. And therefore, that again doesn't blow up the IRA, but it causes the IRA to owe taxes from unrelated business income. So I'm not saying don't do any activity like that. What I am saying, though, is you need to structure any kind of deal that's in your IRA as an investment. And for that reason, I kind of like things that are longer terms. In other words, if you have an option, Connor, and you say, well, I don't put $50,000 into my account, but I have an option to buy this property from you at a set price for the next 10 years, and you have a right to cancel that option at any time before I exercise it. That makes it look much more like what it is, which is an investment, as opposed to just saying, I put out $10 and the next day 50,000 shows up. That's never going to fly, if that makes sense to you.
Yeah.
So wholesale away, but do it in a way that you stay in the deal, and or do it in an honest way and just go ahead and pay the unrelated business income tax because you're actually operating a business in your IRA.
Yeah, that's what I was just thinking. Just wholesale number of houses, grow it up to where you can actually use it to get in some more uh, better, long-term plays. So as far as, a lot of people want to, buy notes with their IRA.
I think that's great. I
Yeah.
love buying notes.
What is your opinion as far as the best strategy for someone who is trying to grow a small IRA? Let's say they have $1,000 in there. What's the best strategy as far as how to partner and how to structure a deal that you could kind of
Well,
give advice?
sure. Well, first of all, I don't give tax, legal, investment, or structuring advice, Connor. You already know that. But, some of the things you can do, we already talked about some of them. I like joint venturing. And as I said, as long as you're not joint venturing with somebody who's disqualified to your account, you may be able to structure it in an advantageous way. And we go into a lot of that kind of stuff when we do our classes and stuff. You could do the debt finance property deal like we also discussed. You could even have your IRA, like I started a business or I should say I owned a business in my health savings account, which was a licensed Texas mortgage broker because before they changed the law and made everybody into RMLOs, I actually had a licensed Texas real estate mortgage broker owned by my HSA, but we did a few transactions, decided it wasn't really what we wanted to do. But the point was I put 500 in and got thousands back out. Perfectly legitimate investment, had other people doing the work, and I didn't run the business. And so that was a pretty advanced way to do it. But even in notes, Connor, even in notes, you can do joint ventures and you can participate in a way in the joint venturing of notes. But you can joint venture the ownership of property, the ownership of notes. You can own businesses. You can have long-term options as opposed to flipping options like you were talking about a moment ago. There's lots of legal and perfectly ethical ways to build it up. And the best way to do it is to get rich slowly.
So what if there's a lot of rehabbers on this call? What if I was to put a house under contract for $10 to $100 with my IRA, and then I borrowed money from a private lender at say 10%? They funded the entire, say it's $50,000 to buy the property, $30,000 to repair it. They funded the whole thing, and I hired a make-ready rehab company where I'm not, and I just say get it done, and then I sell that house and I make 40 grand flipping the house. Does all that money go back into my account, and that's okay to do that?
It has to, because the IRA owns the property. Again, your IRA is a separate legal person from you, just like an LLC that you own is a separate legal person from you. So, I mean, think of it in the outside of the context of IRAs, and it'll be a lot clearer. If you owned a business outside the IRA, of course, all the expenses have to come through the business and all the profits go to the business. So in that case, in your scenario, all the expenses of the loan would have to come out of the IRA and all the profits would go back into the IRA. But because that property was debt financed, we slipped back into the other rules that we talked about a moment ago, where the portion of the profits that are related to the debt, which in this case would be nearly all of them, would be subject to tax. So some of you are probably saying like, well, why would I even do that? That doesn't even make any sense. But you have to look at it in a proper context. First of all, the truth of the matter is that if you're in let's just say a 33% bracket, just to pick one, and your IRA pays taxes even at a 39.6 bracket, people might think that the penalty, quote unquote, I'm not using that in the official terms, it's just the price you pay for doing that is 39.6%. That's just not true. The price you're paying is the difference between what you would have paid outside of the context of the IRA and what you're paying inside the context of the IRA. I'm already at the max tax rate, so it doesn't make any sense at all, not even in the slightest bit, for me to make income outside of it with investments outside of my retirement plan, because even if it causes my retirement plan to owe taxes, it's still cheaper than my personal tax situation. So that's part of it. And the other part that you got to realize is, well, besides the fact that it's just a way to build a small account like we discussed, right? The other thing you got to realize is you got to look a lot of times beyond the instant transaction, right? So let's say you made, what did you say, $40,000 on this, and you ended up paying 20,000. I'm just, no, it wouldn't be 20,000, but $15,000 in taxes, leaving you with only 25,000 or whatever. Well, you still made 25,000 on a $1,000 investment, and now you've got 26,000 to play with. And the next deal, you put more money down and have paid less taxes. You never have to do another debt finance deal in your whole life, and all that money can accumulate tax-free. Whereas if you did that same deal outside and paid taxes on it, the next time you reinvest it, you're going to pay taxes again, and the next time you're going to pay taxes again. So sometimes you have to be a planner, Connor. You have to look beyond the instant transactions to see what the overall long-range plan is. And if you're like our United States Congress, they're not looking beyond the next 2 years when they have to get reelected. But you have to look in the long term to have that strategy. But it's a great strategy overall.
Yeah, no, I think you're right. And most people are going to be in that tax bracket anyway. So go ahead and just pay the tax on it and grow that account, because the next investments, like you're saying, are going to be basically tax-free in there. So that's probably the best way to go about it. Quickly, before you get fun, let's talk about the HSA. Is there any special benefits for the health savings account that you would push towards individuals to opening up one of those accounts?
Well, if you qualify for it, it's absolutely the best account out there. And that a lot of people get really shocked when I say that. I thought it was the Roth or the inherited Roth or whatever. And that's just not the case. With the HSA, regardless of your income level, you can get the tax deduction for putting it in. So if you're in the 39.6% bracket and you put a $5,000 contribution into the HSA, then 39.6% of that number is a reduction in your actual tax bill. That's pretty good. Now, that's good. Just like in a traditional IRA, you get a deduction going in. But unlike the traditional IRA where you get the deduction going in, you also get to pull it out tax-free. So it goes in tax-free and it comes out tax-free as long as you use it for qualified medical expenses, which are really broadly defined. So it's really an incredible deal. And anybody that qualifies for it and doesn't fully fund it is just really wasting a lot of money.
Yeah. And most of your biggest expenses, especially later in life, are going to be medical expenses. So may as well grow that. And so y'all set those up there or at Quest?
Oh, absolutely. It's one of our favorite accounts. They're not big accounts, but they're incredibly important if you qualify for them.
Okay, guys. Well, I hope that helped. Quincy, you can reach him. We'll put his information below. Remember, if you're in Houston, Austin, or Dallas, you can go straight down to their offices. And he's going to have the weekly Facebook Live calls, guys, so go ahead and check those out. Quincy, I appreciate you coming on, sharing your wisdom with us. And, guys, I'll see you on the next episode.
Thank you, Connor. Have a great day.
Thanks, Quincy.